mic, bring the facts. Aaron in the ring, no turning back. Kobe got the numbers clean and clear. Experts in the mortgage space right here. Housing issues, yeah, we dig deep. Every word weigh when the stakes don't sleep. Credit war, you can feel that charge. Every point hit hard, every stance large. Capitol Hill, that pressure stay high. Consolidation makes the small ones fight. Server scene trails, every detail counts. Say it plain, then we write it out. No surrender.
We're back.
Let's go.
Different circumstances, though. I've got beach wear behind me. I've got sunscreen here, a microphone that doesn't work, an iPhone case that doesn't fit my phone, and 59 pages of notes.
You're missing 10.
I'm at the beach.
How is it?
It's great. I'm in Ocean City, Maryland.
Jealous. How's the crabs?
The crabs are great. They're great. They're not as good as Maine lobster, which I know you love. Kobe, what's happening, brother? You're the eighth wonder.
The eighth wonder today. I'm leaning in to you calling me the eighth wonder of the world when you were surprised at a take I had around student loans. So leaning into that moniker, we're going to see how far we can take it. Maybe it'll be my new branding.
Yeah, it's good to see both. Kobe, you have a different background now. So,
yep, in the Bay Area today. I'll be here for the next couple of weeks, and then the big move from the mountains to Reno.
That's exciting, buddy. Look forward to my invitation. We've been talking about a trip, by the way, Aaron.
We're going to go to the Bunny Ranch, right?
No, like the three of us are going on a trip together.
Oh,
yeah.
A bro weekend.
No surrender bro weekend. Are you down?
Let's go.
He's like, who should we invite? I'm like, obviously Aaron. Duh.
Clearly.
All right, so we have a lot to tackle this week, like every other week. Recruiting ethics in our industry. Where do you draw the line? Foreclosures at a 6-year high. What's the data telling us? Those are two quick things. I told you I have a lot of notes here, so I may not even be able to get to all of them. Save student loan repayment is ending. Kobe doesn't feel good about this, wants to make all kinds of concessions, I think, for these poor people that agreed to this debt. AI consumer sentiment says one thing, venture capital says another. AI costs, we'll get into that. Fannie further tightens the credit box. At the same time, FICO 10T is out of the market. A little bit of a contradiction there, perhaps. And the BLS is very much up for debate. And then, of course, we have the war. Looks like it might be back on. I guess real quickly, we can move that to the top and just what the heck is going on here, Kobe? You may actually be right. You didn't believe it in the first place, and now they're trading missiles back and forth. What is going on here, Kobe? What's your best guess?
My best guess is, Trump is trying to continue to push the agenda that he has, and he's not comfortable with ending it on kind of on meek terms. The Iranians are a ridiculously crazy regime and have been for years, and so they're having a hard time coming to terms with the concessions that they have to make. Israel in the mix and the conflicts that they have going on with Lebanon and Hezbollah, that's adding to it. And I think Trump saw the price of oil go down and realized maybe I can push this further without creating any more economic distress. So why not? So, I think we'll get to another ceasefire and we'll be back here next Thursday talking about how the war is back on again, that there just doesn't seem to be any end to this cycle.
Oh, Greg.
I'm looking at the bond right now. So that's at
where's our 10-year?
Yeah, 453, the 10-year.
Mm-hmm.
Looked like we were down a few days ago into the 440-ish range.
Sure.
So that's not good for interest rates. We do seem to have some momentum. Things aren't gangbusters, but we don't need this. That's for sure. And the Republicans don't need this either, do they?
Well, it's just bad news for everyone all around, right? I mean, this is a war we shouldn't have been in the first place, and we just now we're kind of stuck in the mire, and hopefully we can figure a way out soon.
Now we're poking the bear. Speaking of poking the bear, hey, this is a great segue to our first topic. So I got a little bit unhinged this week, I will confess. So I got a call from a branch manager. One of his loan officers last Thursday received this DM. Hi, I heard today that NFM, which is my company, let go a large percentage of its team. If you decide to also make a move, please let me know. I support more than 25 different IMBs looking for branches. Most are paying upwards of 100 basis points on 12 months prior production. Let me know. And so I ended up writing a post about this, and I called James Zeldin out, and it led to a lot of emotions back and forth, depending on what side you're on and what you believe in. But I was accused of using my platform of 40,000 followers for bad, and to me, I'm using it for good. It's never easy when you stick your neck out, but to me, you do it knowing and feeling like you're rooted in the right cause. And the right cause for me is this issue with recruiting that has been pervasive for years and years and years, of sloppiness, of the wrong approach, of having wrong information, of focusing on what's wrong with your company now rather than what you can offer them at your company. And so this really landed in a certain way with me that I was just like, you know what? And so to the people that are saying, well, why not just pick up the phone and call, which that was the response in a post that was made just moments ago from James Kleiman, our good friend here, and a FOTS. He's a FOTS. He's a friend
of the show.
Yeah. The Mortgage Scoop, nothing is private anymore. And so this just landed. The Mortgage Scoop is a great newsletter. This just landed moments ago, where James talks about how I made this post. And apparently his partner, James Zeldin's partner, took exception with this and had some pretty pointed things to say about me, including saying that I should have picked up the quote unquote fucking phone. Basically that, I didn't handle it the right way. I feel like I handled it the right way. This was a way that I chose to use it. I'm amazed at how many people want to tell me what my brand is or what it should be or how I'm on brand, off brand. Your brand is unique to you. It's whatever you believe in. That's your brand. So I'll stop there, and you guys can chime in. Aaron, you can take first crack at it.
So, I have a full-time day job, so I am not often read in all of your LinkedIn chat spats. So I got read in on this one a little bit late, but here's the thing. One, you don't owe him anything. He's trying to poach your team. Why do you owe him a phone call? That is absolutely ridiculous. Two, you're sending a DM to something with information that's not public knowledge, clearly to try to poach, right? So this whole, I believe Kleinman's article at the very end said it was private outreach with no ill intentions. You're trying to steal his originators. What do you mean you have no ill intentions? But the fact that it's become a thing and now it's an article and all of this and we're tattletaling, it kind of just feels like baby bitch playground shit.
Oh, great. And Larry Silver in the comments asked a great question. Why didn't that recruiter pick up the phone and call me before he besmirched us to our employees?
Correct. Exactly. That's right. So here's the thing. My friend and colleague, Gary Royal, told me one thing about how he recruits, that it's based on trust, and you have to build trust. And without a foundation of trust, you're never going to be able to successfully recruit somebody. And so taking unverified rumor and gossip and trying to recruit against that is exactly the opposite. You're not building trust. You're trying to go off of lies, mistruths, half-truths, unverified information to recruit. That's not the way you do it. You need to build trust and build relationships.
Cobe?
Yeah, I want to find out more about why Erin doesn't have time to jump into the fray on LinkedIn during her day. Like maybe she needs some help. How can we help you? Look, what's getting lost in this conversation for me, and you can have an opinion on it. I agree completely with Aaron. I agree with you, Greg. I did show up in the comments there to support you on this because, this guy deserved it. Bottom line, if you're acting on information that's either lazy or malicious, you deserve to be called out. And if you're comfortable talking about it in the dark, you should be comfortable talking about it in the light. That should be the barometer. That should be the test. What's not being talked about, and I haven't seen it in any of the comments, although I haven't been back in there since I dropped mine, is what about the loan officer? Why is it okay to try to recruit loan officers with information that's either false or lazy? And how many instances do we see of loan officers being lured to companies on false information where false promises are made? There's no recourse. There's no complaint process through the MBA or whatever other governing body we want to lend power to for this. And the loan officer is the one that often gets recruited. And then if they get recruited with a big bonus package that has a clawback, they're the ones that suffer in the end after the promises were unfulfilled. There's no protection for that loan officer in our industry. We don't have any agreed upon recourse. And so the only possible recourse and the only possible reply here was what you did, which is to say, get off of my turf and lay off of my loan officers. And so I think we need more structural arguments, more structural things in place to protect loan officers from these kind of practices. And again, whether they're malicious or lazy, to me doesn't matter. But that should be the real direction of this conversation: is how do we protect LOs and how do we make this a fair playing ground for everybody?
Yeah, I want to read something that's in James Kleinman's Mortgage Scoop article that he just released. So this gentleman, James, his partner, is a name that a lot of people know in this industry from the Housing Wire days. Richard Bittner. He was the CRO at Housing Wire and a co-founder. He was part of the group that sold Housing Wire to Clayton. And so this is what he says: James wouldn't have sent this message if the info had come from outside of the organization. Somebody may have lied. That's possible. I don't know. Maybe someone had a vendetta, but it came from inside the house. And that's the reason we did this. It was a private fucking message is what he says. Private fucking there's nothing private. Okay. There's nothing private out there. So this is the reason I did this, because if you have the balls to go out there and make statements, then you need to be able to back them up. And nothing is private. Everybody knows things get shared, especially when you have loyal employees. And another story I heard from this is that they heard from an underwriter, we let some people go. So what's the correlation between hearing an underwriter was let go and reaching out to a loan officer to say, we heard you lost a large percentage of your company team? The bottom line is they didn't know shit. They were extremely lazy. This was a cut and paste job. My understanding is they sent the same message to 11 or 12 people. It's irresponsible. And if I lose followers over it, or people think that I'm abusing power, then that's okay. I'm all right to be the sacrificial lamb here to make the point. And I guarantee you, these people and others will be more careful the next time they craft a message, right? And make sure that their sources are okay, and that maybe they lead with the benefit they can add, not what's wrong with your company. In terms of my brand and what it should or shouldn't be, and all these people that want to tell me that I'm off brand, or that, somebody wrote, I used to really believe in you. I thought all of us was great. Josh Katz, a name I respect. He came out and said, apparently it's some of us, not all of us. Diego Sanchez said that I was punching down. It's amazing, all these opinions. I put my foot down on FICO. I put my foot down on the MBA with a single credit score. I put my foot down when Sierra Pacific rolled into Union Home and decided not to pay their people. I put my foot down when Draper Kramer decided not to pay their people, and I got some people paid. So I've talked about this problem plenty. I've posted many times about this. Clearly, it doesn't move the needle. This will move the needle. And I apologize if I offended anyone. Believe it or not, it wasn't a personal attack against James. I know it feels like it. He just happened to be, the one in the crosshairs at this time. And I don't wish him ill will. I don't wish their company ill will. So that's my last take on that. Anything else from you guys?
I will say
agree
one
with
more
everything
thing.
you just said, except you shouldn't be apologizing to anybody. You didn't do anything wrong.
Well, and I think there is a lesson in leadership here. Is for those of us who are leaders at our mortgage companies, we need to make sure that our loan officers know that we are transparent and that we have an open door policy. And if they get this slop in their DMs, come talk to us. Let's have a real conversation, and we're willing to share information with you. We're not hiding.
Oh, and then Bittner went on to say that clearly we must have something wrong if somebody on the inside gave them this tip. I mean, he's now, not only did he run over us with falsities, now he's doubling down and saying it's our problem. I mean, that's outrageous. I mean, it just shows you that I made the right call, right? So, I'm happy with
ultimate in gaslighting.
Yeah, and I also want to say that I had to talk to the branch manager of this individual for an hour to convince him that, you know, it's not true. We didn't let anybody go. In fact, we're growing. And he wanted me to make a promise to him that I wasn't going to go anywhere for several years. I had to literally peel this guy off the wall because of this irresponsible recruiting. And even if it was true, it's still irresponsible. So we'll move on. Nayang, if you can do me a favor, because I don't have great visibility here, and pull up the next visual on foreclosures being at a 6-year high. And what's the data telling us? Kobe, my man, you are a viral star. You got your first feel for what it's like, I think, to really, really go absolutely bananas with a LinkedIn post. You got over 100,000 impressions on this post and talking about how the pandemic produced basically 2 different sets of people. Dive into this, but first tell us, like, where do you stand on the impression count right now, and what was it like to have a post just take off like that?
Well, you know, it was I've had others that have done this in the last couple of years since I've started really leaning into LinkedIn. This one right now is about 140,000 impressions, and it's really stirred up some conversations, and the conversation actually went in a little bit of a different direction than I initially thought it would. So the basic premise here is that the foreclosures are up significantly, 6-year high since 2019. 39% of them, as you can see on the board there, came from people who purchased 2022 or later when they bought at the top of the market, both in terms of home values and interest rates. So there's the haves and the have-nots that we're seeing, and so this brought up, you know, now look, we're at 280,000 foreclosures now. Just to give you some context, at the height of the great financial crisis, we were at 4 million. So this is not doom porn. This is just, hey, this is interesting because it talks about really 2 things. One, it leans into the discussion about the marry the house, date the rate, because the people that married the house are still dating that same rate, and that marriage seems to be in trouble if you look at these numbers. So it leans into that conversation a little bit. Number 2, a lot of the comments, and this is something that, you know, we've talked about and we should continue to talk about, and I did another post this week about it, is the variable costs of home ownership, property taxes, insurance that seem to be skyrocketing and a runaway train. And you know, are we having the right conversations both about down payment? Are people putting down enough money? And what are the dangers of not putting down enough, and the consequences of not building equity fast enough through that? What should people be thinking about and looking at when it comes to homeowners insurance? What should we be doing from an underwriting perspective in our industry when it comes to insurance, and trying to gauge where those premiums are going to go over the next 3 to 5 years? So the real point of this post was to say we should be having different and more meaningful conversations with our borrowers. And those conversations should reflect the market, and they shouldn't just be sales tactics. They should be real introspectives into where the market is and what it means to buy a home now. And are you really ready? So it obviously got a lot of traction. People seem interested in the conversation. And I think it's something we should be actively talking about.
Aaron, we addressed this before, you and I did.
Yeah.
Remember, this was tied to the what's our responsibility as mortgage professionals.
Correct.
You know, how deep into the truth do we go with a consumer? Like, you can't get on with a consumer right now and make guarantees about home appreciation. We should be having the same conversations probably about taxes and insurance, and there should probably be some governors in place when we have these moments where those ancillary things are taking DTIs up. We should somehow be able to real-time pivot, and the agencies should maybe even assist. IMBs aren't going to like hearing this, but you know, perhaps there should be a cap on DTIs in moments like this for certain borrowers.
Yeah, I agree. I think especially in the FHA book where we need to be looking at this, and you know, I am glad that Kobe kind of clarified this is not doom porn. I know we'll have friend of the show, Logan Motoshami, jumping in our DMs with some charts telling us where we're still at, you know, all-time lows on foreclosures. So, you know, we're not flashing the red light yet, but we are flashing, right? We are saying that there is a market with stress. And I had a post a few weeks back that somewhat talked about this, that a lot of people disagreed with me that we have a K-shaped housing economy. And I think this just supports that we really do. We have the pre-pandemic and the post-pandemic. And I'm part of that post-pandemic group. I bought my house in Austin in February of 23. But the one thing I think we also need to be considering here is the implications of builder loans, right? Builders, well, they've put forth significant concessions, so they did not have to lower values. And a lot of these concessions were FHA buy downs, permanent buy downs, right? And even permanent buy downs with temporary buy downs on top. And when those payments change, when your escrow adjustments come in, these borrowers get into trouble, and they have zero. Not only do they have zero equity, they are also underwater in some cases, especially where there was a lot of new builds at these higher values that resale just can't compete with. And so I think there's just a lot of factors that we need to be considering, going into this. Again, we're not freaking out just yet. I do think that if unemployment starts to get crazy, I think that, if we start to see a ton of foreclosure sales come in and values go down even further significantly, that we need to look at it, right? So there's things that we can look at before we need to panic, but we need to have our eyes on it.
And look, this underscores to me that the importance of, if we're talking about the loan officer role in the future of our business and how to future-proof against AI and AI voice agents and automation, and is there space and room for a human loan officer in the future of our business? These are the points where it comes into play. If you are leading with communication, with education, with guidance, if you're having those right conversations with borrowers, that's how you future-proof. If you're talking in sales points, marry the house, date the rate, or whatever else you can come up with that might rhyme to entice somebody to buy a home, then you're doing a disservice and you're making yourself ultimately obsolete in the process. So I think it speaks to a broader conversation about what the role of the loan officer is now in a market that certainly has a lot of variables and a lot of implications. And talking about a 30-year fixed rate like it's the most rock solid thing in the world, when we know that that's not the case anymore, I think that's the broader conversation to be had here.
Correct.
I know it's extreme. We're coming out of an extreme low interest rate environment followed by an extreme high interest rate environment. So it's not exactly historical apples to apples, but isn't this the natural evolution of the cycle? Last in, first hurt when things stop improving and increasing. Like what is so beyond the pale in this instance? Or are we just going down into the valley of the latest cycle?
Well, I think this is why we need to be having these conversations, because we need to be looking at those numbers and saying, do we need to adjust in real time? Do we need to make changes to DTI profiles? Do we need to be in certain areas looking at what are our insurance rates going up?
But we know that's a problem. Who's going to do something about it? Everyone's been screaming about this.
It has to be done at the agency level, right? It absolutely has to be done at the agency level. And I think, we're going to talk a little bit about that here, but the stress on consumers is real. There's a lot of things that are coming down, it's going to make it even harder on them. And so individual lenders are not going to go and start saying, well, I'm not going to originate this loan that I get an AUS approval on because the guy down the street's going to do it, and I need the loan too. And so we need to, at the top level, start looking at, do we need to look at adjustments in guidelines?
Wait till the student loans start to hit, huh, Kobe?
Yeah.
Want to jump into our next topic?
We're all staring down the barrel. So last week, we talked about this proposal that has, a very outside chance of ever going anywhere, but it was the 2% cap on student loan repayment or interest. And we use that as kind of the fulcrum to have a conversation about student loans and their role in the lending industry. This week, we're coming on this point where the Save Student Plan that was a product of the Biden era that was since unwound by the courts, that's coming to an end. And so borrowers now have 90 days. And I think we're getting near the end of that 90-day period, which is what makes this story timely, for those borrowers to choose a new repayment plan, which is going to add hundreds and hundreds of dollars to some people's monthly bills, which in turn will affect their ability to buy homes. And so the conversation that we've had is around, obviously this is a separate issue than as it relates to mortgage, but this is going to affect 8 million people. And that's a significant swath of the home buying population. College educated people, the ones that have the higher degrees, tend to have the higher debt. And I think there's a direct line to be drawn from student debt, which has, it's $1.77 trillion right now. It's gone up something like 1,200%. Tuition's up 1,200% since 1980, which is 5 times the rate of general inflation. If you want to look at where the first-time buyer age has gone from 1980 to now, it's gone from about 28 years old to 40 years old. You can draw a straight line from student loan debt rising in lockstep with the first-time buyer age, because it's locking them out on the DTI basis. And we have DTI stats to back that up as well. The DTI denials went up from 29% to 35% just over the last few years. So more people are getting denied because their DTIs are out of line. So there's a moral and ethical discussion to be had around student loans, and there's a practical discussion to be had around student loans and how they're affecting our industry. But the much broader conversation, I know I've used broader conversation 3 times today, but the broader conversation is, yeah,
that's the winner. That's the winner today.
I'm
Good
moving
job.
away from pearl clutching into broader conversation. But the conversation that we need to be having is, what are we doing with our the youth in this country? Are we selling them a bill of goods when it comes to their college education? And the other thing, we talked about was how these student loans are not dischargeable through bankruptcy, and that was a provision that was made in 1976. That's since been expanded in 2005 to not just federally sponsored student loans, but private as well. And so what that's created is this desire to put out as many loans as possible, as quickly as possible. And from an economic perspective, the incentive has only been for the colleges to raise their tuition because they know that somebody's going to fund it on the other side with a loan that a 17 or 18-year-old is going to take out and now be responsible to pay for the rest of their life. And you can make an $80,000 mistake with credit cards when you're a kid and you can discharge them in bankruptcy. You can't make an $80,000 mistake with student loan debt and discharge that in bankruptcy. So there's some structural flaws to all of this that I think are important from a ethical and economical standpoint, but they do affect our industry because we can see the first-time buyer age getting pushed farther and farther north of 40 as this continues to be an issue.
Well, I think we can pin this for another day, but I think we can disagree. Like I would disagree that 40 number is reliable. It has increased, but if you look at the HMDA data versus the whoever did that mail away survey, I think that 40 number is in question. But we'll set that away for Mike. At the end of the day, it's getting bigger. Right.
Yeah,
it's getting higher. And right. So I don't want to take away from that, because ultimately I do agree. We had this conversation, and the thing that scares me, and this kind of goes back to the prior conversation that we had, is I went and ran the numbers. So, under today's environment, if you have a student loan reporting as a $0 payment on your credit report, Fannie, Freddie, FHA have very clear guidelines as to how you can calculate that payment on half the percent of the balance, 1% of the balance. I went and compared those calculations to what the new payments would be under the multiple different payment guidelines using the $55,000 average balance at various median incomes. And in basically every single case, the calculation that we're using is far less than what the new payments are actually going to be. So one, you have borrowers who are qualified on, in some cases, hundreds of dollars less than what these new payments are actually going to be. And in other cases now, you have more swaths as these payments get into place that are not going to be eligible, right? So you have a servicing issue that is going to happen, and you have a new borrower situation. 45% of FHA first-time homebuyers have student loans. This is going to be a big deal, right? These payments are going to be a big deal. And then you also have to look at the ramifications that this is going to have on other forms of debt, because if I'm now having to make a higher student loan payment, and a higher student loan payment, which by the way, could eventually turn into a garnishment, could make it so that I have a federal debt now on my Kivers, whatever. What's that going to do now if they have to make a decision between paying their credit card and paying their student loan? So what ramifications is this now also going to have on payments of other forms of debt? Studies have said that people are going to choose their student loan over paying their credit card or even their car note. And so there's going to be downstream impacts on this. And I honestly think that's probably why earlier this year, the Trump administration pulled back on doing garnishments. They said it was to make system updates, but I think that, the credit industry may have stepped in and said, hey, this is not good for us. So, but regardless of the reason, with these new payments, we haven't qualified people for them.
No, wait, we haven't qualified people for them. Okay.
Meaning the people who were in these payment plans with zero payment due, if we qualified based on the 0.5% or 1% of the balance, and we got somebody into a loan on the max DTI on that amount, when these plans are now coming due, the new payment plans are going to be significantly higher than
what about that. But they obviously agreed to make a payment at some point.
Yes, correct.
Yeah. So, and that was delayed, correct?
Yes.
Yeah, so there's a lot to this story, okay? First of all, let me bring it down from the sky down to the ground. The concern is that you have people that are already struggling with their DTIs, with all these other things we're talking about, taxes, insurance, the high rate that they thought that they were dating, that they're now shackled to. Right. So then you tack on a $400 payment, a $600 payment, and all of a sudden your DTI, now you have to start to make some of these decisions you're talking about. So the concern is that defaults will go up. That is the concern, right? So, the other part of this, which Kobe's not really gone into here, is Kobe believes that a lot of these students were wronged, that they were sold a bill of goods in the first place.
I mentioned it.
Yeah, but you didn't go deep into it. And this is eighth wonder of the world material here, Kobe, as you know. Kobe and I have disagreed on this. His take is that many students, because of their age, because of promises made by for-profit institutions, got in too deep and didn't know what they were getting into, and now they're holding this bag, and they don't have the education they thought they'd have, or they can't get the job that they thought they'd have. That doesn't land with me. And the other question here is they had a payment that was delayed. What did they do with that money? What did they do with that money? Why all of a sudden, were they not taking that $500 a month that they were supposed to be paying, that they were given a grace period on? Did they not invest that money? Is that our fault too? What did they do with that?
You're assuming they even had that to begin with.
Well, whatever the payment is, they obviously at some point were going to have a payment, right? And that was delayed. We just talked. That's why I teed it up there. So what did they do with that money that they could push out? Right.
But that's my point. I don't know if they ever had that money. If you look at where tuition has gone up, it's gone up 5 times versus inflation since 1980. Guess how much general wages have gone up versus inflation since 1980? 0. So we're talking about people coming into a world where tuition costs 10 times what it used to cost in 1980, against 5 times against inflation, but they're coming out with the same wages against inflation that they did. So it's gotten much more expensive. And they're not coming out with a job that's commensurate with repaying those loans. So doesn't that seem to be that the structure is
broken? Why aren't they
broken?
coming out with the job commensurate with the?
Because we've not seen the wage growth in this country. But on the other side, we've seen.
I mean, there's no promise to see wage growth.
Well, there's a promise to get a job to repay the student loan debt. That's the whole premise of this. Is that come to our schools, get an education, you'll get a good job.
That comes down to more than your degree. It comes down to how sellable you are, how believable you are, how passionate you are.
But that's not what the colleges are selling.
That's why we need changes to the system. We need changes to the
colleges
system.
are selling. Come get an education.
Let me give you another angle to this. Let me give you another perspective to this, which we talked about in our production meeting. I'm just angling here, okay? So if you have a bunch of people that are all of a sudden, that wanted to get into a home, but now can't because they suddenly have a DTI that's higher, or they're just not comfortable because now they're looking at a student loan payment of $600 to $800. In theory, that could open up opportunities for the rung beneath them, right? Or if there's less demand for the properties that are out there, then potentially some prices will start to go down, and that will bring affordability more into the light. So this is not a black and white light switch issue. There's a lot to it, and I love unpacking this. This is a great topic to keep an eye on.
Well, one thing I do want to say, because I've been the last 2 episodes screaming about needing caps, and I do want to acknowledge that as of July 1st, there are, thanks to I think it was under the One Big Beautiful Bill, or whatever they're calling it now, the American taxpayer or whatever. There actually were caps put in on some programs. So graduate loans are now capped, still at like $200K. And the parent loans are now capped per student with a lifetime. And I think each individual person now is capped at like $237,000, which is still an insane amount of money. But it's a start. And so I do want to at least acknowledge that as of July 1st, there's some semblance of caps and sanity being put into the system.
Kobe, do you think that the government should set up some kind of a hotline where you can plead your case? And if you can prove beyond a shadow of a doubt somehow that you were misled or sold a false promise, that debt should be forgiven, therefore increasing our deficit?
Bankruptcy.
I mean, first of all, I think there are structural reforms that need to be made to the whole thing from the bottom up. The economic incentives are clear. The more that the student loans are able to be pushed out to borrowers that don't have any recourse on them, the more the universities are encouraged to raise their tuition because they know that the student loans will be there to fund it. That is the structural issue at hand. If there's some recourse there, if there's some balance and regulation there that actually makes sense, I think this problem gets solved. Should there be a hotline? I don't know. I just think we're asking 17 and 18-year-olds to make enormous decisions without all of the information. That's my problem.
I don't know. I don't have the data on how many 17 or 18-year-olds that qualify for student loans. So they're going.
Everybody, they all do.
No, you're not. Let me finish the question, please.
Yeah.
Hey, paper that, right? Dollar bill, yo. Let me ask you this question. You know, the majority of them probably have parents, right? They're probably
yes, they all have parents.
middle class or up. And so, you know, these people aren't going in blind. My kids aren't going to go in blind. Your kids aren't going to go in blind. So to paint this picture that you have a 17-year-old wayward out there in the ocean, you know, buying everything that's sold to them. I mean, it's a little bit Pollyanna.
I'm not making the claim that they're making these decisions on an island without any support, but they are making the decisions without enough information and without the proper information. Most people don't know the stats that I put forth, and that's the parents as well as the 17-year-old. The problem is that even if that 17-year-old gets support or not, they're still the ones making that decision and that commitment that can hang around for the rest of their lives. So that's the issue.
Here's the thing. It's just like, how come vaccine manufacturers don't have reprieve from lawsuits? How come student loans are special in that they can't be discharged in bankruptcy? They should be treated like any other debt.
Well, the argument to that, Aaron, though, is that if they weren't, the rates would be a lot higher on them, right? And there'd be a lot less competition as far as giving that money out. So, yes, I mean, that's the argument to that, is that they'd be more difficult to obtain. And which
well,
is
a lot of these loans are backed by the government.
I'm with you. I'm just giving you the other side of that. I'm with you.
Accept.
So with you.
I'll let go of this, Kobe. I could talk to you about this for hours. We do have some people here in the comments. Our buddy Larry Silver, financial literacy and affordable education.
Are we going to talk about Larry's ode to you on his LinkedIn?
I have to mention Christina Capel, who I know personally. She worked for NFM at one point. Just a total pro. And I know she's definitely a fan of the show. When we do get our gear up and running, which we're working on right now, I'm going to send you something, Christina. Don't let me forget. The financial aid office will send to the 18-year-old, here's what you owe after the credit for scholarships and your federal student loan, and your balance is X. They send no disclosure, nothing to address content on the student loan repayment requirements other than the 18-year-old knows, oh, I don't have to repay it until after 6 months is up after graduation. There is reform needed with the entire student loan topic and college affordability, which I know everybody here agrees to. Let's
wise words.
Thank you for that. Let's go into the AI consumer sentiment versus venture capital, because there is a rub right now that my man Kobe Hackalier is tracking that was brought to the fore by the great people at the Stratmore Group. Kobe?
Yeah, so Stratmore has an arm of their business called Mortgage Customer Experience, where they poll customers routinely on behalf of different lenders to find out about the experience of getting a mortgage and what's working and what's not, where the leads are leaking, if you're the mortgage company wanting to understand how you're dealing with your customers. And they found in the latest customer experience survey that fewer than 2% of refi borrowers and fewer than 4% of purchase borrowers found their lender via AI or digital discovery, and over 90% are still referral or prior relationship. So this speaks heavily to what we've been talking about. We debunked the Veterans United survey a couple of weeks ago and talked about the Cotality survey that supports these Stratmore numbers, that customers still very much want a human in the loop when it comes to getting their mortgage. But then we've also seen that the venture capitalists, and I think, Greg, you had a different interpretation of what VC stands for, but venture capitalists, the venture capitalists are putting...
What did I say?
I can't recall right now, and I won't recall.
Oh, yes. That. Yeah. That's an inside joke. Yeah, got it. Okay, my bad.
Yeah. We're just...
Would we share that with the POTS group?
That's group chat. That's group chat.
I will, but this is what happens when Greg's on vacation. We're like a step out of sync this week. Don't you feel it? Like a half a step? It's because he's been on the beach too much.
I think it's hilarious.
I think we're moving pretty well here. I'm happy with the pace here.
We're doing great.
I think you're just because you're in a different setting. I think maybe you're a little verklempt. Maybe.
I feel like I was in the same setting last week, wasn't I? I don't know. We have to go to the tape. I don't know. I forget where I am week to week.
Let me call Warner Wolf. Was that a snort, Aaron? What was that laugh?
Yes, it was a snort.
That was outstanding. I love snorters. That's great. People that laugh,
Oh,
snort,
I
you know.
thought you said something else when you said that last time. Sorry.
Got it. All right, Kobe, get into it.
All right. So juxtapose that the human in the loop element, it backs up the Cotality survey, which we know the Cotality survey was robust and the sample size was large. And we know that Cotality has found that 55% of buyers prefer having a human in their mortgage loop. So the numbers in both of these surveys seem to speak the same language, that borrowers do want a human in the loop. But then we've seen that the venture capitalists just poured something like $45 or $50 million into a bunch of fintech companies. So we started to have this discussion. Well, if the surveys are showing that borrowers are wanting this human in the loop, why is all this money being poured into fintech companies that are deploying AI at scale to try to capture borrowers? And so the conclusion that we've been debating is, well, is it bifurcated amongst the transactions? Does what customers want with a purchase transaction differ from what they expect in a refinance transaction and differ from what they might expect in a HELOC? And if you look at where the VC cash is going, most of it is going to the HELOC fintech sector that is targeting customer equity for a couple of reasons. One, the HELOC transaction is I want my cash out of my house and I want it as fast as possible. So it's much more of a transaction than it is a journey and a process that purchases. And number two, the HELOC process has a lot less regulatory issues around it. There's no 3-day right of rescission. There's no RESPA issues like you have with purchase mortgage and refinances. So that's why the money is going there towards the lowest regulated and the highest transaction basis possible scenario.
It's also an easier loan. It's smaller amounts.
Yeah.
Right.
Yeah. For all those reasons.
Easier guidelines.
Equities capped at whatever percent. I mean, I don't think we're back to hundreds yet, but maybe we'll go there.
And it speaks overall to companies that are now enacting servicing as a play. Getting in front of your customers to capture those HELOC moments and those refinance moments. You can do that from a direct-to-consumer call center that's attached to your servicing arm because the customers are okay with that relationship. But if it's a purchase, you're going to want to have the retail loan officers on the ground. So that's where, so all of this is kind of supporting those arguments of where we see the industry going.
Yeah, in terms of the money that's being thrown around, it's not a secret that many feel like mortgage is the last adopter of really wide-scale technology. And the other thing is the stock market and the markets are up. There's a lot of money out there on the sidelines. It needs to be deployed somewhere. Aaron, your thoughts?
Couple things. So one, I think the Stratmore survey is just yet another good signal for where lenders, especially retail lenders, should be investing their AI development dollars right now. And that's in the middle of the stack, right? One of the things that came out of the Stratmore survey was that the biggest frustration and the biggest thing that impacts net promoter scores is when borrowers feel frustrated by being asked for unnecessary items or being asked for the same document multiple times, right? And that should be no surprise to anyone. And so really that tells me that as a lender, where I really want to be spending my AI dollars is not necessarily front of the funnel communicating and dealing with the consumer, but really in that middle of the stack, making sure my process is as clean, smooth, and efficient as possible, lowering my cost to originate, but also making it so that I am eliminating these duplicative and annoying requests to consumers. But I also think that we shouldn't miss the signal, because if you look at where consumers are going to AI to get smaller, restaurant recommendations. I actually used Claude to find and book a massage for me yesterday, right? Things like that. They're more heavily leaning on AI. And while now in today's environment, people, especially for these big, large financial transactions, want to have the human in the loop, I think that as we go on and get more experience with AI, more and more people are going to be comfortable with that. So I also think as an industry, we can't rest on our laurels. Otherwise, we will be ripe for some outside company to come and disrupt us. So I think we still need to be focusing on how can we, how do we adapt and change as consumer preferences change, and keep our eyes on that and don't lose it. Because if you look at the statistics, I realize that a lot of college grads are booing AI, and I don't blame them, right? They're being told they can't use AI in their college because it's cheating, but then they're losing their jobs to AI, when they can't get a job. And so they're frustrated with it, but their usage of AI is super high. And so just because, you don't trust it doesn't mean you're not using it. And so I just think we need to make sure that we do have our eyes on what the signal is going forward.
Yeah, I think there are a lot of signals out there. I mean, I've got a few notes here. MIT study found 95% of business AI projects delivered no measurable return. Michael Burry, who we've talked about before, argues tech giants are hiding the true cost of AI chips in their accounting to make earnings look better. There's an argument the money's just circling. NVIDIA funds OpenAI, which buys chips from NVIDIA, so demand looks bigger than it really is. I think the takeaway for me here is that this is not going to be this thing that replaces us all. It's not. And the other thing that we need to be mindful of is there's just a handful of companies that own the AI space right now, and so there's a lot of control out there. I mean, you saw Claude disabled one of the I forget the name of it, but they have
Fable.
Yeah, they disabled that. These companies are taking all this information in and all these queries in, and they're looking at what's being coded. And so we're like, the world is playing out all of these ideas. We're just making those 3 or 4 companies stronger and stronger and stronger and give them more and more and more control. So I think
but we've seen that before. We've seen that before with the onset of new technology. There's always the 2 or 3 or 4. I mean, look at how AOL.
Well, this is different. This is different. We're willingly. Most people hold things close to the vest. We are feeding these machines all of our best ideas. They have a front row seat, and we're paying them to take this information. Think about how outrageous that is.
I don't think it's any different than any other advent of new technology. It all starts with 2 or 3 or 4 companies that dominate. Then the competition starts to roll in.
That's not the point I'm making. It's not the point I'm making. The point I'm making is that they have a front row seat to all the innovating that's going on in their engine. There's never been another moment in time, I don't believe. And I understand that usually 3 to 4 to 5 companies have the lion's share of the market share, and then things settle in. This is different because all of the ideas, all of the coding, the next great companies are being created right in front of Dario and Anthropic. Who has ever shared playbooks like that in full plain view?
So your fear is the feeding of the beast.
Yeah, for sure.
Yeah.
Okay.
Well, Alex Karp had a really interesting 20-minute rant, and I am no fan of his, but he had a really interesting 20-minute rant last week about how companies are overcharging and how it's right now the system is just a complete mess that I think is worthy of listening to if you can understand what he's saying.
Hey, speaking of a complete mess, how about the BLS? That's typically a pretty messy thing. Kobe, you wanted to talk about this. Now, Young, if you're back there, and we have a slide pop it up here. But, Kobe, we're used to seeing revisions downward. There's been some talk that we could have some revisions upward. And there's been talk that maybe the BLS will go the way of the dot plots, which seem to be getting less and less popular. I'll break this down.
I thought we had a clip from Yahoo on this, didn't we? Yeah.
We did, and we do. And this is why you are saying that I'm a little fuzzy today, especially considering right before we went on, we covered this. It's really amazing.
I feel like videos at status quo, though.
No, that's all right. This is Yahoo Finance and Indeed Director of Economic Research, Laura Eldridge, talking about this. Whoa, I'm not hearing her.
We're joined now by hiring firm Indeed is now out with some new insight on the labor market. And I'm pleased to say we're joined now by Indeed Director of Economic Research, Laura Ulrich. It was really interesting that we did see that pullback within leisure and hospitality, because heading into this report, the World Cup was supposed to provide such momentum to that sector. What do you make of that? And what is maybe sort of the tea leaves that you're reading from this report this morning?
Yeah, I will say I was surprised to see the leisure and hospitality number as low as it was this morning. I am a big soccer supporter myself, so I've been to a couple of the World Cup cities, and there's a lot going on this summer with the World Cup. Also, we have obviously just in a couple of days our 250th celebration as a country. So this is a busy summer. So I was not surprised in May when we saw leisure and hospitality coming quite strong, but was surprised to see it pull back today. I will say it's just 1 month, so there can be survey noise for sure. There could be some variation where we see things kind of come back strong again in the August report. So I'm not going to read too much into it, but that was a surprise.
Yeah, I too am a soccer supporter, and I was surprised that the U.S. barely showed up against Belgium. But what a fun time in the World Cup. it's interesting to me, the last two revisions from the BLS, and this is why I kind of wanted to dive into this, because there's some really anomalous stuff happening here. The last two revisions from the BLS were like 900,000 jobs. The one before that was 800,000 jobs. And here we see 5 different Wall Street firms, when a jobs report came in at half of what the expectation was, talking about how there should be a revision up. And that speaks to the inaccuracy and the fallacy of BLS reporting in general. It's a very odd position to take, because all of the BLS revisions historically have gone down, and this one they're saying should come up. And so I started thinking, well, what's in it for these Wall Street firms to be talking about how this should be going up? So I came up with a couple of different theories, and these are theories only. Number one is this provides cover for Warsh to hold steady and not do anything. This gives him the ability to not react to this, and when calls for a rate cut will come in, and which could potentially affect the portfolio stability of some of these bondholders who came out saying that this needs to be revised. Number two, Warsh has publicly said in his first press conference about how he doesn't think the BLS data is reliable, and maybe we should be moving towards more privatized data sources. Now, who benefits from that? Companies like the woman that you just put on that clip, the director of research, Indeed, that's a job posting platform. They would benefit from that. Credit card reporting. They're all these private companies that would potentially benefit from being relied upon for this data. And who gets to invest in and prop up and act on the information from private companies? Wall Street. So to me, this is a concerted effort from Wall Street to give cover to Warsh and to also push forth the notion that we need privatized data instead of BLS data. So that was my take on this story. That's why I found it interesting this week.
Meanwhile, we're coming off of downward revisions, right? So we've not had an upward revision, from 172 to 129. Aaron, is this a hot topic for you?
Yeah, I mean, obviously, I've been all over the jobs data. The one thing I will say is the reason it was revised downward is because the original estimate included seasonality for it. And as much as Kobe has enjoyed the World Cup, if you look at maybe using hotel occupancy as a barometer, hotel occupancy has actually been flat. We haven't seen the big pop in hotel occupancy numbers. And so I think perhaps the need for jobs was overestimated for World Cup. But you know what? We also have two more revisions that are going to come in before we see any kind of a reliable number. But that is exactly why we need to be looking at alternative data sources. Kobe's absolutely correct in that where there are several, Bank of America, several, Goldman Sachs, Chase, all of those who have their own data research and that would stand to benefit for greater reliability on private data sources. But I don't think that you should discount that, because that doesn't mean that those private data sources don't have better data than what the BLS is giving us, right?
With you on that.
Yeah, absolutely. But you have to bring out the fact that there is a potential conflict of interest there, and that has to be brought up. But I also think that part of the reason that they're coming out here is because Warsh has said we need to look at alternative data. And I think this is, again, a signal from the market saying, yes, we want this. Yes, this needs to be something that we're looking at. We don't know who is going to be on this task force yet. So I think it also could be messaging to the people, whoever is going to end up being on that task force, that this is what we need to look at, and that it kind of tacitly providing support for making changes in the numbers that are being utilized for the Fed rates.
No, we certainly need a better indicator, right?
Yeah.
Because the market reacts the minute the number hits the tape. Everything goes haywire one way or another, and then it goes haywire again when it's revised. It by nature of the BLS, it's always revised 2 or 3 times. So it's like, correct, they should come up with a different instrument. We'll see who benefits. I mean, I think that if you have stocks, if you have a 401k, you should benefit from a more consistent reading, right? And maybe they won't need to go back multiple times. They'll find some algorithm. They should be able to. Lastly, Kobe, looks like the credit box is tightening at the same time that 10T historical data. Aaron, you okay?
I'm good.
I think she's admiring her highlighting work. That's why she's smiling.
No.
I think if you're thinking to yourself that you're having a good hair day, you're absolutely accurate. You are having a great hair day. So if that's what you're talking to me, I want to. Kobe, you look good too today. I don't think I look so good, but
you look well rested. A whole week on the beach. You look fantastic.
Yeah, vacations are not. I need a vacation from the vacations. Does that sound familiar, anyone?
No,
All right.
boy.
Anyway,
I feel like you've been at that beach house for like 4 months, by the way.
I feel like it's been 10 years. Can't wait to drive home the minute I shut this computer down in a couple of seconds. Anyway,
The
Fannie
family's all
further
in the
tightens
car.
the credit box at the same time. FICO 10T historical data is out. Kobe, what are the downstream impacts?
Well, I found this story to be interesting because all of a sudden I get this email, and I think it was from the MBA talking about how, hey, Fannie just came out with this kind of vague statement about modification to moderate reduction. I'll read it from the screen if I can see it. A moderate reduction in the number of loan case files that receive and approve eligible. So there's a lot of layers to this story. Number one, we seem to see Fannie and Freddie moving in a more conservative direction. We know there's been directives around ITIN loans. There's been the special purpose loans are sunsetting finally on July 21st. I did a post on that today if you want to check out my LinkedIn. And then we also have this juxtaposition against Fannie removing the 620 minimum this past November. So different signals, different kind of moves by Fannie and trying to figure out what they're doing. And then layer on top of that FICO 10T just released 12 years of data, so the lenders can kind of digest what the trended data means versus the static data. And I never get data and data consistent. I'm always one or the other on those.
Depends if you're watching Star Trek or not.
Yeah, or it depends on if I'm listening to the director of research from Indeed, it might be data. So
Data.
I think, yeah, let's look at the data. So I think all these things are interesting. And to me, it's like, all right, well, if we have this FICO 10T and it's supposed to give us better results and perhaps make more borrowers eligible, that's certainly what VantageScore claims it can do with the renter data, then what does it mean if Fannie on the other side of this is tightening the credit box? And does it also mean Fannie and Freddie are moving towards privatization and trying to clean up their balance sheet by moving more of these loans into the private sector anyway, and trying to look cleaner for a privatization? And maybe the 620 was just kind of for appearance's sake to look like they were getting more inclusive. But meanwhile, behind the scenes, what they're not doing as much of a public job announcing is how they're tightening some of the standards on the back end. So to me, there's some layers here about where things are going. I think at the end of the day, to me, what I really think is interesting here is this discussion that we haven't been having, which is there's a lot of opacity around Fannie and their algorithms and their underwriting models and what they're looking at. And don't we deserve to have transparency? Isn't that what we're moving towards with the credit scoring? Why can't we have that same transparency with our GSEs? So I know I just dumped a lot on the plate here, but that's why this whole story was kind of super interesting to me, because there's so many things to unpeel and it's a giant lending onion.
So if you're out there listening to this, Aaron, you're thinking, okay, changes, tighter, what changes? And we don't know that yet, do we?
We don't. They haven't given us. If we go by what they've said previously, it's going to be layered risk, high LTV, DTI. I think what could have happened, if you look at the timing for when they removed credit score, the credit score minimum, we're right now to the point where those loans are starting to go EPD if they are, right? And so are they getting an early indication on how those are performing? And perhaps they open the box a little too wide on those super low FICO loans, and they're seeing that performance data and they're needing to make an adjustment. There was an analyst that came out last year when the changes were announced saying the models aren't tested for these low of a FICO scores. And so it's untested, and we're going to get too many loans originated than we really need to, even though you've got lower LTVs, lower DTIs built in. So there is that. But I think this story also goes in and it brings in other topics that we've talked about. We're about to see student loan payments go up much higher than what we've been calculating them at. We have insurance costs that have been going up. And so, and look at the performance of the Fannie Freddie book compared to the FHA book. Fannie is making the adjustments that we're saying FHA probably needs to look at on the DTI side, right? And so is them updating the model a good thing? Perhaps, maybe, but they've got to give us transparency around this. They've got to let us know we're out there originating these loans. How is my pipeline going to be affected, right? I've got loans that are, borrowers that are pre-qualified, things like that. So to me, the fact that they're making the change isn't necessarily the thing. And our boy, Tim Rude, friend of the show, who we love, on his Daily Dose was all over this earlier this week, this is one of the things, the stories that you would have been read up on if you were reading his Daily Dose, is there's just no transparency around this. So what we are left with is, in the absence of information, we're left to speculate. Is it because they went too aggressive on 620s? Is it because they're planning to go private? Is it because it's a reaction to student loan payments about to go up? All of these things, then in silence, they leave us to speculate. And that's really, ultimately, I agree, is the wrong thing.
Kobe, you want to bring up the caboose on this one?
Yeah, well, it's just really, really interesting things to keep note of. And, another reason why I think this show has become as important as it is, because we bring these topics to light, and it gives us the opportunity to discuss them. And I'm hoping it gives the industry an opportunity to discuss them. But again, we need more transparency from the GSEs. If privatization does offer a route, I think privatization offers some short-term pain in terms of rescoring risk and how the secondary market is going to view loans. But I think ultimately, good for the industry, good for the borrower. I'm now in a position where I'm convinced that we need that to happen at some point soon.
I mean, based on all these headwinds that we've talked about, I'm in favor of them tightening the credit box. I think it makes sense, because ultimately the lender ends up holding the bag anyway.
I'm not opposed to it.
So, yeah,
I'm not opposed to it, but be transparent about it.
I get it. Well, give them time. When did this come out? Isn't it pretty recent?
Well,
it is recent, but it came out with no information.
Yeah,
But
Aaron, you're on ResBog. You're tight with the folks that are doing the great work at the MBA. Maybe you can do some digging. I know they're probably trying to get clarity too, right? I mean, but we did hear Bob Brooksmith say at one point that he would potentially be in favor of tightening things up on in the lower end of the credit box on FHA in exchange for lower MIP or some kind of relief with the fund at the 6X. So
Yeah.
if you could bring something back to us, but just real quickly on Tim Rude. No, I can't get enough of his newsletter. I mean, Impact Capital is just incredible. The Daily Dose of Real Estate. He is a FOTS. He is a friend of the show for sure. And they just launched the Washington Policy Implementation Tracker. 30 federal housing policy requirements tracked from directive to actual rule. So, now you know what's in the works, what's stalled, which deadline actually hits your business or next. It's just incredible. And it's free.
Love it.
You got to go get it. This has been a great show. I appreciate you all bearing with me. I know I had some, I'm not quite cruising at my altitude here. I flew through some clouds. We had a jet stream, I think it was in the wake of another plane that was 2 miles away. But I am getting in my car after a week here in Ocean City, Maryland, and immediately heading back home. So I should return to normal, which most people would say I'm not that normal. My normal, whatever that is, next week.
Can't wait.
I meant what I said about your hair, by the way.
Thank you. I actually washed
Hair
it.
looks good.
And Kobe, you look great too.
Well,
Will you be the 8th wonder of the world next Thursday or no? What do you think?
I don't know. It depends on how our production
TBD.
meeting goes. I make
TBD.
it a new nickname. Yeah, you never know.
Where would we be without Na Young? That's the question.
Our favorite.
Yeah, she's
Yeah.
back there. I mean, she's doing all this editing. She's just going crazy back there, trying to keep up with us. Now I popped her up on screen. She's like, oh my goodness, my hair's in a bun. Do I turn the camera on? Yes, you turn the camera on, Na Young. You take a bow. Doesn't no
The
one
real
is still-
MVP.
no one cares about
She
your
is.
hair. It's all good.
She's
Thank
still
you very
recovering
much.
from the moms last week. She's still in recovery mode.
Yeah, we
On
love
me.
you. We love you. Been a great show. We'll see you again next Thursday, everybody. Until then, long.
No surrender on the show. We go toe to toe. What's